On mute.
Okay, well, great. Thank you, Carol, and thanks for the kind introduction. I think that's truly the first time I've ever been referred to as the big show, so I'll try to live up to that expectation. But I'd like to just comment today. All the tax items, as you might imagine, are so intricate and interrelated, and my goal really is just to comment on and just discuss in a conversational manner the different benefits that are out there for you. I mean, we can't solve the world's problems today in these areas, but I think if you can leave here with some ideas and some thoughts to push through in your decision-making process and your asset acquisition decisions, and maybe in your interactions with your financial advisors or your accountants, for those of you who may not be accountants already. These are the kind of things that I think are just very relevant to this process, and I see these type of decisions all the time, and it's very often the very types of calls that I get from my clients to discuss. So I guess moving forward, I just wanted to mention, obviously we all are aware of the widely publicized financial incentives of the HITECH Act, but to obtain those financial incentives, you have to make certain investments and certain commitments, by a medical practice or by your business to obtain those. And fortunately, our tax system is really a system of incentives, and the government provides a lot of tax benefits to people to get them to do things they want them to do. So in addition to the financial incentives that they're using to motivate the health care to move towards utilization of technology, the tax code provides a lot of incentives to help you get there too, so you can not only earn a little bit more money from the rewards, but you can also have some tax savings in making those investments. And this is a real quick question or a very quick answer. I guess it's been framed to me as a very complicated issue, but the question I often get is, are the financial incentive payments taxable? The answer is yes. IRS Code 61 says any income that you receive from any source or any manner is taxable. So we start there, and everything else is the exceptions, and there are no exceptions for that. So that's the first tax matter. But now let's think about ways maybe we can save tax by handling our investments in the technology properly. As we all know, the major components, for example, of an EHR system are the software, the hardware, and oftentimes people forget that you may have to modify your facility to install or maintain the hardware and software. As a matter of fact, I recall in our previous office we had to install a refrigeration system for our server room, and I recall that costing around $15,000. And believe it or not, that's actually not a building component. It can be a part of your technology system, and you can get the tax benefits associated with that. So those are things to keep in mind as well. And the other thing that's often overlooked are tax benefits associated with training costs, because these are really, I think, the four components of investment that are necessary to get your infrastructure in place for this. And in my article that I wrote and presented to Carol recently, one of the comments I make, and I still stick by this, and I've had many software vendors tell me the same thing, though, is if you're not investing in your training costs, you're likely to fail in your implementation. If your vendors don't encourage training and almost even require it as a condition of purchasing their systems, you might want to think twice, because that is probably the most critical component of actually success in this, without regard to financial or tax incentives associated with that. The other comment I wanted to make, too, to kind of make sure we're all talking the same language, is a lot of times I've been asked, well, gosh, what are all these tax credits I'm going to get for investment in technology to comply with the HITECH Act? And normally, as an accountant or a tax advisor, I interpret that as, what are the tax deductions I'm going to get? There's a big difference between a deduction and a credit. And a deduction means that it's a an expense or a write-off that you can offset against your taxable income and reduce your taxable income, or the base of which you're going to pay tax on. A deduction is worth the dollar amount of the deduction to you multiplied by your tax rate. So, for example, if you have a $100 tax deduction and your tax rate is 35%, you'll save $35 on that deduction. It's still good. 35 cents is nothing to complain about. But that is different as compared to a credit, because a credit is a dollar-for-dollar allowance against any tax obligation you may generate or incur. So, for example, a dollar of credit applied against your tax liability is a full dollar of savings. So there is a big difference, and to me as a tax advisor, it's a large difference. But obviously, I make sure that I make people that I'm discussing this with aware of the differences. And we'll be talking primarily about deductions. So these are not necessarily dollar-for-dollar tax savings, but obviously there are ways to monitor and enhance your practices or your business's cash flow to help pay for the investments that you make. We will talk about a couple of credits, and I've seen some huge benefits from those. Obviously, we'd all rather have credits, but most of these items are, in fact, deductions. And the main deduction that revolves around technology is depreciation. And depreciation is merely, I guess, a term to art or a financial term. It basically says you can recover your investment as an offset to your taxable income or as a deduction over a certain period of time. In other words, when you buy a computer server and backup system, that computer server has a life to your business enterprise of more than 1 year. The IRS generally, under common depreciation methods, will not let you get a write-off all in the first year, because they know that's going to provide service to you for multiple years. So depreciation, basically, in simple terms, is just recovering your investment over the life or the useful life of your investment. And we'll see later on, though, when we talk about incentives, the IRS has bent the rules for the taxpayers to allow them to get faster write-offs, and the benefit of that is to encourage the investment and, in many ways, stimulate the economy. And so when we talk about that, those are the types of expenditures subject to depreciation, and to be distinguished from, for example, a supply purchase. If you purchase a supply, it's likely that you're going to consume that supply at that time or within a short period of time, and that's truly an operating expense, whereas when you buy something that lasts a longer period of time, you have to spread that expense over a greater period of time. So we'll be talking about the concept of depreciation, how it affects your investment, but also all the different special rules and exceptions that allow you to get those faster deductions. The other thing I mentioned, and I think is really, really interesting, is because this is a court case where the taxpayer, the Hospital Corporation of America, was successful in presenting their case in the tax court against the IRS, where they were claiming that certain expenditures that they were making in their hospitals were not really parts of the building, but were really parts of the equipment or the medical equipment that was housed in the building. And why is that relevant? Well, the reason is a hospital building, for example, has a depreciable life or a recovery life that you get the tax benefits for over 39 years. A piece of medical equipment has a 5-year write-off, so you can recover your investment in 5 years for tax purposes versus 39 years. And they won that, and it was very successful, and this actually wasn't the first case. The first case was actually in a grocery store environment related to their air conditioner units. But what it really means is investments that you make in your building or in your facility that seem like facility investments may very well be really part of your computer system for tax purposes. A good example is I use the air conditioner to cool the special cooler for our server room. Wiring, if you have to put in special wiring for your computer or enhance your network cabling in your building, typically electrical wiring in a building is part of the building, but if it's related to a technology item, such as medical equipment, or in this case, we're really referring to computer equipment, you can write that off as part of the equipment and you get a much better tax benefit from it. So don't think in terms of evaluating your expenditures for your system as only the piece of the computer item that comes in from Dell Computer. You're also going to be thinking about other items that you may have to do to your building or your facility to make it technology worthy, I guess is the best way to describe it. And I mentioned before, over the last few years, in ways to stimulate investment and to assist businesses, they've allowed what is known as bonus depreciation, which allows you to have even greater write-offs in the early years of your equipment. So it helps you get the tax benefit early on when you make your technology investment. And for the past several years, they've been allowing bonus depreciation of 50% of your investment in the very first year. So for a $100 investment, you get a $50 immediate write-off in that very first year. And a lot of that came after the 9/11 incident as a way to stimulate the economy and provide some incentive for taxpayers to reinvest and get their businesses going again. And it's really stuck with us. And as a matter of fact, currently, we are currently in an environment that will end at the end of 2011 where your bonus depreciation rate is actually 100%. So under the bonus depreciation rules, you get 100% of your write-off in your first year, even though you're buying a piece of equipment that, according to the IRS, is going to last you 5 years, which is pretty nice. There's also another depreciation option that we call Section 179 election, and that is, and Section 179 refers to the Internal Revenue Code section that provides for that. But that essentially allows you to also write off all of your purchases in the first year, subject to several limitations. And so that leads me in to say, well, what is the difference? And, you know, there is a difference between bonus depreciation and Section 179 expensing. And that's where your tax professional really needs to come in, because there is a difference. For example, the bonus depreciation election is an all-or-nothing decision, and you have to make that decision for all of your like-kind assets that you acquire, and you're not able to pick and choose, whereas Section 179 expensing is asset-specific. So you could buy one computer, for example, and elect Section 179, and you could buy another computer and decide not to do that with it. So you have a lot more flexibility. But the way I like to see it is, this is one of those true opportunities when you ask your accountant what the bottom line is, and they can truly say, well, what do you want it to be? With these options available to me, I could probably create a depreciation bottom line expense for a business pretty much within certain ranges of whatever best suits their tax and financial planning needs. So those are some of the things that you take into consideration, and we could spend another 4 hours on the pros and cons of that, but just be aware that it's out there, and again, a good way for you to recover some of your tax benefits associated with your investment. The other consideration, and I'm sure, and if any of you are already making your progress towards looking at your options, you've said, well, a lot of these folks want to lease this stuff to me. Should I lease it or should I buy it? And that's, quite frankly, a very common question that I get. And I would submit that, to a certain extent, it doesn't matter whether you buy it or whether you lease it, but there are certain things that you need to be aware of. Leasing, for the most part, and as you notice from the outline, there's a category called an operating lease or a capital lease. Those are basically two types of leases. And an operating lease, just simply put, is renting the equipment. You take no true ownership to the equipment. You have no rights to acquire the equipment. You essentially are paying a monthly payment, and you're getting to use the equipment. If you stop making the payment, they come and pick up the equipment. It's usually a fairly short-term arrangement. A capital lease is more of what most of you are probably seeing in some of your equipment purchases and other asset-based investments. A capital lease is a scenario where you make a series of payments over a period of time, and it's a commitment. I mean, you are committed to that payment, and even if you no longer are using the equipment and don't even want the equipment, you have to make those payments. The difference is also what happens at the end of the lease. A lot of these leases that I see out there have what is known as a bargain purchase, or you just get to keep the property at the end of the lease because they don't want it back after a 4-year lease. Who wants a 4-year computer back in your office that's probably worn out? But what that really is essentially a purchase of that equipment. I tend to use the word disguised purchase, but it's not really disguised because that's kind of a sinister connotation, but it's really just an alternate way of financing your assets. But the thing to keep in mind, though, is oftentimes these lease payments have a high rate of interest built into them, and it's not often, although it's very easy because your sales representatives will encourage you to lease it, just sign the papers, the payment's only going to be X dollars a month. There's a high rate of interest often built into those, and sometimes as high as credit card rates. So it's very important to evaluate those to make sure you understand what your true cost of owning that equipment is, because I don't know that I'd be eager to enter into a lease with an implied rate of interest of 12 or 13% when I could possibly borrow from my bank at 5 or 6%. So you need to keep those in mind. But I want to show you on this exhibit kind of what I'm talking about and where you can see the true costs of a lease. And this is the kind of evaluation I do when I get called by one of my clients, for example, and they say, should I lease this equipment or should I buy it? But a good example is if you're going to lease an EHR system, and we're just going to use the generic system here with a fair market value of $60,000. And basically what they're saying to you is you can lease this equipment for 60 months and it's only going to be $1,500 a month. We're going to ask that you put down 2 payment deposit, your first payment and your last payment, for example. And at the end of the lease, we're going to allow you to choose to purchase this at a bargain rate of 5% of the original value. So as you can see in my first part of this slide, the events, you're going to acquire a system worth $60,000. You're going to give them a $3,000 deposit, and you're going to make 58 monthly payments of $1,500. And at the end, you may or you may not make a $3,000 payment to acquire the actual equipment. Running that sounds very nice, but if you notice up at the very top, I said, when you run that, backwards, so to speak, and say, what is my interest rate? Your interest rate is almost 20% on that purchase. Over the life of the lease, and you may want to scroll down here I'm having to scroll to see, I'm not sure if that's necessary for you, but if you want to scroll down, I've kind of detailed out the payment stream, and over the life of a lease, under this scenario, you have paid $93,000 for a $60,000 piece of equipment. Obviously, when you borrow money, you do pay more than the actual face value of the item, but at 19.97%, you're looking at a $33,000 cost. Sounded good up front. Yeah, I can handle $1,500 a month, but boy, if you look at it this way, it does cost you a lot of money. I wanted to show also, wanted to look at Exhibit B, which is another iteration of the lease. And this is what happens if I did the same thing with a bank loan, and the bank charged me an awful rate of 7%. I'm going to borrow 100% of the cost, the full $60,000. I'm going to pay 7%, and I'm going to amortize it over the same period of time, 60 months. First off, my payment's only $1,188.07. That's almost a little more than $300 a month less. And again, scrolling down to the bottom, what you see is that your true cost of owning the equipment is only $71,284, as opposed to that original number we were looking at on the lease of $93,000. You've saved, $21,000, $22,000, and you're paying a reasonable rate of interest. And, I think it's commercially reasonable to expect that over a 5-year period, $11,000 of interest is probably not an absurd amount. And that's not to say that all leases are bad, because many times I've seen promotional rates on equipment, or they've got a sales incentive to get something out to the market, and sometimes you can find some good rates on leases. And when that occurs, I tell my clients, let's get all over it. You're probably not going to do much better at the bank. And there are other benefits. For example, it doesn't impair your banking credit worthiness and things like that, because you don't have to use your lines of credit or other things. So, it's something to evaluate, and always make sure, don't just automatically sign that lease because it sounds like a good deal. A little bit of analysis, and I think you will be well served. So keep that in mind. And also the other side of it is, and I said originally, is a capital lease is essentially a purchase. So what that means is you have to depreciate, as we discussed before, depreciate the value of that lease at $60,000, and then you also have interest expense equal to that difference that we were talking about as well. So for all practical purposes, I think the trick there is evaluate the economics of the lease, but assume that for tax purposes you're pretty much just making a purchase. The other thing I wanted to mention was training costs. And with training costs, what I see here in Georgia, and my practice is most of my clients are in Georgia. Georgia has an incredibly beneficial tax credit program for training costs. And what they in Georgia, and I did a little research in preparation for this presentation tonight and for the article that I wrote, and there are many states out there that have different training incentives, whether it's government funds to actually put in your pocket to help you train your staff, or credits, as Georgia does, which takes into consideration the amount of money that you're spending on training Georgia citizens to be more proficient with technology. There are a lot of incentives across your state, and quite frankly, I find the Georgia credits very huge. I had a 2-physician pediatric practice that installed their system, and their Georgia credits were, between the two of them, about $10,000 or $12,000 each. And remember the difference between deductions and credits. That's $10,000 or $12,000 each in their pocket. I had another practice, a very large cardiology group, and they were getting $10,000 or $11,000 per shareholder in Georgia credits as well for their training incentives. And these are all pre-approved by the state too. So the state almost pre-audits them. So it's hardly risky once you've gone through the steps. And again, why do the states do this? Because a lot of states take a lot of pride in having very qualified, very capable workforces, and Georgia's one of those. And again, from the various credits and benefits I've seen across the United States in my research, a lot of states feel the same way. I would urge you very strongly to don't overlook the state opportunities for grants and credits and other funding that'll help you implement your system. Otherwise, training costs I guess after all that, that's so exciting, but after all that, though, in addition to that, the training costs are deductible as deductions. You don't have to capitalize and depreciate them the way you would the actual equipment, as long as they're broken out separately on the bill. If it's just lumped in with the system, that's a different story. But we're assuming that they're separately stated and laid out there. The other thing to mention too, and I guess I jumped the gun on my outline on the state incentive credits, but we were talking about a lot of the various federal tax incentives for making investment in technology. A lot of states do not follow that. So that's something to keep in mind, but honestly, in my experience, even when there are things that my state, Georgia, does not follow, the dollar differential, the fact that the state tax rates are so dramatically lower than the federal tax rates that for the most part, I let the federal decision drive my decision, and I don't pay a lot of heed to the state, but obviously I am aware of it. You need to be aware of it, because it helps in evaluating the entire decision. But again, the federal dollars that you can save are so dramatic that it often is outweighing the state benefits. But what I wanted to also do is, after a lot of this jibber jabber about tax benefits and tax savings and this, that, and the other, I guess if you're trying to manage your practice or run your business and make proper valuations, the question is, what does it really mean to me? And I put together a couple of exhibits to kind of lay this out, because when I'm advising my clients on these things, the things I look at is their cash flow, because I think that's really the most important component of a small business. Obviously, other factors may kick in as your business gets larger, and if you're reporting earnings or, depending upon, your tax status and other things. But I work a lot with practices groups from one physician up to probably 30 or 40, and cash is still king in those environments. But I think these exhibits may be helpful to kind of give you an idea of what I find to be valuable when I'm advising my clients. And Carol, as we talked before, can you help me be sure that I give the best image to our listeners?
They are just going to auto adjust it using the lower left, so I think you're going to be
good to go.
Yep.
Well, I think the first thing to start off with is this is the basic example. This kind of tells you how it works. And so what I'm showing here is an example of a business who otherwise might have $500,000 worth of taxable income, or you may even consider this as an individual. Think of it from one person's perspective. They've got $500,000 worth of income, and fortunately they've got $500,000 worth of cash on hand, but they've got to make a $100,000 investment in technology. So what I like to look at is lay it out side by side. You've got your tax column and your cash column. You make your investment in your equipment and you buy it for cash. You write a check for $100,000 and buy your equipment. You're left with $400,000 worth of cash in the bank. That's your income for the year. That's your cash income from the year. But as we said, the IRS will require you to write off the benefits of that investment over 5 years, which means you pay $100, but you only get to write off $20. So now your income that you have to pay tax on is $480,000, but your cash is only $400. So what can cause a lot of anxiety for folks is that when they have income but no cash. In this case, you see an example of someone who has an $80,000 difference. But fret none, even though it's a lot of stress in the first year. You get a write-off in the second year, like we said, for depreciation, on through the sixth year, because it's a half year in the first year and a half year in the last year, so it lapses 6 years, but it's truly a 60-month period. But when the day's done, you see that your true income is still the original $400 minus the investment in your equipment, but you see the variations month to month, and that year to year, and that first year is kind of rough because you had $480,000 worth of income, but only $400,000 worth of cash. And if that income is what you're living on, or what your shareholders are living on, or what the business needs to survive, that differential can be very, very significant. But let's add a twist to it, and I'm going over here to the next exhibit, Exhibit D. And this is a scenario where how you can use financing to smooth out your cash flow. So we go to the same exact scenario, but this time we're going to borrow the cost of the equipment, or borrow the cost of the investment. So what happens on the cash side is you purchase your technology, but then the bank lends you the $100,000 to cover that investment, and over a 5-year period, the first year you would pay back $18,000 worth of that loan, and in the first year you would write off $20,000 worth of the value of that through depreciation. As you can see here now, your tax column and your cash column are almost right on the money. They're the same. Now, over time, you can see that your depreciation varies over the life over the period of time, and your amortization varies, but as you can see, the differentials are not nearly as significant as they were in the first scenario, and over time, again, we end up at the same place, $400,000 worth of cash, $100,000 spent on your investment, and you're back down to back down to a net $400,000. So that's an example of how we use financing, actual bank financing, to smooth out the cash flow. Of course, there's an interest cost associated with that, but you've also got to remember that that's the cost of spreading the investment over time, but the fact is the investment is going to serve you over time, so it makes sense, and I don't think people like to take those huge bites on their cash flow all in 1 year. So that's an example of how we can use financing to kind of smooth that out. And if you get creative and work with your timing on your loans and the timing on your investments, you can even match that up better. And I spend a lot of time with clients sometimes trying to arrange loan scenarios that match that up so we minimize even the modest swings that we have there. So if we move on, I've got another example here where we have an example with bonus depreciation. So instead of having to write everything off over the 5-year period, what does writing things off all in the first year do for us? So this is an example of the loan scenario where we're borrowing money, but we're taking advantage of the full tax write-off in the first year. Something looks a little different here at the end of period 1, doesn't it? You've got your taxable income is $400,000 and your cash is $481,000. It flipped the other way. You've got a surplus of cash this year. That's pretty exciting. And it worries me as an advisor because some of us are tempted to run out and spend that money, not realizing that, as you can see, it kind of goes the other way for the next few years. For example, in year 2, you're now $18,000 in the other direction, then 19, then 20, then 22. Again, at the end of the day, you're always going to go back to zero because of the scenario, but because of that depreciation hit in that first year, you can swing your cash flow the other way. I mean, I like to say it as you have a tax holiday in year 1, and again, I mentioned that you can see in the footnote at the bottom, the interest cost to spread that out also was $13,000. That was the interest on a loan at 5% for $100,000. I always remind my clients, save your money because you're going to have to pay taxes in the future. But as you can see, with certain elections and certain flexibility in the depreciation rates, you could probably develop a series of depreciation elections to let you match up your depreciation a little bit better and keep that cash flow from fluctuating wildly. But I've kind of deliberately given extreme examples to give everybody an idea of what the range of the possibilities are under these scenarios. And then I believe that is all of my exhibits. But I guess, again, in conclusion of, my prepared remarks, just wanted to lay out, make everyone aware of the flexibility that the tax laws and the tax incentives out there allow for people. But again, even as a tax advisor, I make it very clear to people that the tax motivations cannot be the only decision factor, as we showed by looking at the lease versus buy assumption. There are a lot of economics that go into this, and the taxes are only one factor on that. So those are all things to be considered. There are many moving pieces there, but with careful analysis and consideration and good advice as needed, the options are very easy to sort out, and they can be sorted out, and a good decision can be made to help let the tax laws and the tax rules assist you in funding and acquiring your EHR systems to get in compliance with the High-Tech Act. And at this point, Carol, I'd be glad to open it up to any questions.
Oh, great. Yeah, we got a few that came through. So the first is you talked about this rapid depreciation ending this year. Is that correct?
Yes,
is it
that's
ending?
correct.
So
Well,
that
it
will continue
doesn't
on,
end this year. Let me be more specific. The rules it originally started at around, I think they were allowing bonus depreciation in the 25 to 50% range, depending upon your geographic location, right after 9/11, and actually in response to some of the Katrina damage as well. But as the economy got poorer, they expanded that to make it more general, and for this period starting for assets acquired and placed in service after September 8th of 2010 and through December 31st of 2011, it's 100% bonus depreciation. But then after that, it goes back to 50% for, I believe, another 1 to 2 years. So there's a huge window of opportunity this year, and fortunately for us and people interested in this topic in relationship to the High-Tech Act, there's not a better time than this year to make your investment anyway. So the opportunities for these savings or acceleration of the savings exist right now.
Right, right. In your experience, have you found EHR vendors willing to negotiate costs, finance rates, et cetera?
Usually what happens on the finance rates, it's usually an outside lease vendor that somehow affiliates with the vendor.
Oh, right, right.
Software vendor. So a good example, it's like if you buy a car from Ford, you would maybe get your financing from Ford Motor Credit. They're somewhat related, but not completely. They're both two independently profit-oriented items. And a lot of the vendors go out and they find good lease vendors to provide the financing for the leases so that it helps them sell their equipment better, because they, first and foremost, they want to make their money on their equipment or software sales. But after that, they also make a little money on the leasing transaction as well, but they're trying to find them well-suited. Then it goes further to say that, if they want to run a promotion, they're really pushing their product, maybe they'll actually buy down the lease rate for you, so that's when you might be able to find those favorable rates. But I do find that the lease rates are not necessarily negotiable. I do know of vendors out there that are even independent from the software vendors or hardware vendors that make a lot of concessions on the timing of your payments. For example, I know a vendor that will let you lease equipment or software from them using their services, and if, for example, in consideration of a brand new startup medical practice, for example, they may not require the first lease payment for 15 to 18 months.
Oh, wow.
And so it's a deferred payment plan. I mean, obviously you're paying for that privilege, but that flexibility is huge. So those are the kind of things that may be negotiable. I'm not so sure that the rates are truly negotiable, though, as far as the implied interest rates or what have you.
Got it. What's the biggest mistake you've seen a practice make in acquiring an EHR? I
think two things. The first thing I've already mentioned is the lack of commitment to the training. I think that's a huge mistake. I've seen it in my own accounting software implementations in my own office, that if you don't have the right commitment to training, it's just not going to succeed because people will be frustrated. The other is, I think, unrealistic expectations. I don't know how many of the listeners or attendees have ventured into this area at all, but they need to count, the physicians even need to count on a couple extra hours a day in the early stages of this to make sure their charts are prepped properly for their visits and that everything's done properly. It does take a lot of time, commitment, and to think that they're going to show up one day and everything's going to be working just fine with no extra effort will cause nothing but disappointment. And I recall walking in some of my practices for evening meetings, say at 7 o'clock, and the physicians have been sitting in their offices working on their medical records, in this preparation and follow-up that I was describing at 7 o'clock from clinic ending at 5 o'clock because they did have the commitment to do that. But those are a couple of the things that I see are the deal killers.
If we donate all of the computers because we're replacing them with a new system, can we take a tax write-off?
I get asked that a lot too, and actually the answer is a very qualified yes, you can get the write-off. As we all know, the IRS often gives with one hand and takes away with the other. So the answer is yes, you can get a deduction, but the way they make you calculate the deduction gives you extremely minimal benefit. So although the answer is yes, the real answer is no or minimal benefit, but you are doing a good thing.
You're doing it right. You're doing a good thing, right. And what are the range of services you provide to medical practices? That's a great question.
Oh, well, thank you. I appreciate that question. But Gates Moore and Company is a tax, accounting, and consulting firm for medical practices, and we provide the full range of CPA and management consulting services for the physician-based environment. Now, as we all know what's going on in the medical community, a lot of hospitals are engaging our services to help them with integrating their physicians into their systems and helping their physician practices run well and helping them with issues there. We do fair market value, valuations of medical practices. We have several appraisers on staff, and we are doing a lot of that now to make sure that hospital systems and medical practices are in compliance with all the various regulatory authorities when they're doing transactions between each other, whether it's something as basic as on-call coverage or something as elaborate as a hospital system acquiring a medical practice. So we like to say we help physicians with anything that goes on in their practice except seeing the patients. We like to leave that.
Well, on that note, Mark, I think we are a wrap of the big show, as I call it. Thank you so much for taking your time this evening in Atlanta, and we'll get this recording and hand out to all of our members, not just ones that attended tonight, but to all of our members in our Head to Cancers group. And thank you again so much, and thank you, everybody, for taking out your time.
Thank you. It was truly a pleasure.